All right, the Fed's going to start tapering their asset purchases, whatever that means, I'll explain. But are we going to see a taper tantrum in the market like we did last time? I'll explain coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so the Fed was on Capitol Hill last week, and they were just getting grilled for creating the biggest asset bubble that we've seen in modern history, driving inflation up the highest level we've seen in decades, creating all sorts of speculation in the market, and this enormous, creating the biggest wealth gap this country's ever seen. No, they weren't grilled on any of that. That would be too real, right? And of course, no, they didn't do that. They were instead just explaining their policy and their policy change, answering questions. And yes, they announced what everyone expected, we all did, that they were going to slowly roll back, slowly start pulling back on the amount of money that they're printing and injecting into the economy every single month. They call that tapering, and where they're slowing down the amount of asset purchases that they're doing. Right now, the Fed is injecting, just about $120 billion a month into the economy. What they're doing is they're creating some securities, and they're using that money to buy other assets. And when they do that, $120 billion worth every single month, they then hold that asset on their balance sheet, and that money that they use to purchase that asset is now free flowing in the economy, but it's really the financial economy. It doesn't actually make its way down to the people for a long time, if ever. Check out any of the recent videos I've done about the velocity of money. This does not help with that at all. And so they've been doing $120 billion a month. And what they announced last week was they're going to start slowing that by $15 billion a month, starting this month, starting November, and extending that all the way through next month. That's right, December. So they said, we're going to do this for November, December, and we'll see how things go. And we reserve the right to make any changes that we want at any time, blah, blah, blah. And they've got their next meeting in December, middle of December, I believe. And that time, I'm assuming they'll give an update as to whether they're going to continue this, which I'm sure they will, unless the economy goes haywire. And likely they'll announce at that time whether they're going to raise interest rates just a little bit, or will do so starting the beginning of 2022. So that's the gist of it. The question is, how's the market going to respond? Well, thus far, the stock market's been okay. Last time the Fed announced this tapering, there was a taper tantrum. Ben Bernanke, at the time, back in 2013, I believe it was, started leaking that they were going to slow down their asset purchases. And turns out at the time, the Fed took their balance sheet from $1 trillion to approximately $3 trillion at that time. The market really did not like the idea that Ben Bernanke was going to slow down that asset purchase. And so again, then we had QE2, QE3, QE twist, QE infinity. It goes on. And that's how we go from a $1 trillion balance sheet now to, $8 trillion, pushing $9 trillion, just an insane amount, okay? And so, but last time, the market did okay. 2013, the stock market had some ups and downs, but it was a great year. It was just then after that, the middle of 2014 to the middle of 2016, where the market went up, down, and it was flat for those 2 years. And that was a difficult time for investors, because they thought, well, wait a second, why am I doing this? I'm not really making any progress. But 2013 was fine. So why do they call it a taper tantrum? Look at this chart. Interest rates, as Ben Bernanke leaked about this tapering they were going to do, interest rates doubled. That's right. You're looking at the 10-year Treasury interest rate moved from about 1.75 up above 3% just in a matter of months. And when interest rates surge like that, number one, it creates some havoc in the economy for borrowing costs and can contract the economy pretty quickly. People are less willing to borrow. Think about that right now. If interest rates for mortgages increase significantly just in a short period of time, what would that do to the housing market? So it created some challenges there, and then also created some challenges for bond investors, right? Your safe haven, your slow, steady bond investors created some challenges there. As interest rates go up, bond investments go down. Are we going to see a taper tantrum this time in the bond market? It's hard to say. All the experts right now say no. And just based on the tapering announcement in and of itself, I doubt it. I doubt we'll see a taper tantrum. Right now, the 10-year Treasury at the time I'm recording this is still below where the 10-year actually was in March of this year. Not March of, pre-pandemic sort of, or right at the beginning of the pandemic. No, March of this year. We're still a little bit lower than that. Based on this announcement alone, I don't see a taper tantrum happening. To me, I think we're more likely to see interest rates surge if inflation data continues to surge, which I would expect. I would continue to expect that. Or if the Fed starts raising rates aggressively and makes a surprise announcement or maybe a misstep as they go about unraveling their involvement in manipulation in the economy. So what do? Is your portfolio, let me ask you this, is your portfolio structured that with all of this signaling from the Fed, that signaling basically the economy is strong enough to get off of, doubly, triply life support is basically what we're saying. That should be a good thing for the stock market. And therefore, if the stock market surges, is your portfolio positioned to take advantage of it? Or if the Fed does make a misstep here as they go to taper and the markets drop, is your portfolio structured to protect? In bond investments, are you structured to be able to participate if bonds are doing okay? Or do you have a structure within your bond side of your investments, your low risk side, to protect if the inevitable occurs or the unfortunate occurs and we see another taper tantrum? Not inevitable, but unfortunate. Another taper tantrum. Is your portfolio structured for that? And then lastly, I would ask you, do you have any upcoming borrowing, anything like that, so that if interest rates do surge in the short term, could you be stuck, or should you consider an alternate plan? Work with your CFP on all of those answers. I doubt we're going to see these big gyrations as the Fed goes to unwind this. But if you look back through history, most big market events, traumatic market events, the Fed took some action, made some changes, and it impacted the markets in a very violent way. And so who knows, as they go to start making some changes, the economy is very complex. It is a very complex, finicky little system. And so make sure you're working with your CFP to ensure that you've got your financial house in order. If you don't have a CFP that's helping you, you can always contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.